Welcome, guys, to another episode of the Wealthwise Show. I'm your host, the Wise Investor, and today we're going to embark on a Wealthwise journey into finance, in particular monetary policy. Now, last week we talked about monetary policy, and this week we're going to finish up on that conversation. So, to get started, let me get some housekeeping out of the way. Remember, guys, that this podcast and this episode are not to be used as personal investment advice, financial advice, or anything of the sorts. If you want or you're interested in something that I may say, please do your own research and talk to your financial professional. Make sure you talk to your advisors and things like that to make your decisions. Don't use me. And also my opinions on any companies or my opinions at all, anything at all. It's my opinions only. Does not reflect the opinions of my clients or Simplicity Wealth or anything like that. Strictly speaking, anything I say is me coming from me. So with that being said, let's go into today's show. So today I wanted to talk about, as you can see, it's Friday. The day, I think it's about to be 9 o'clock, 30 minutes before market open. So I'm going to try to get this done before then. I've already done my work for earlier, my trading and all that stuff. I got that out of the way this morning, but I still want to see what happens in the markets. So this week we had a couple of reports come out. Remember when I said the economical reports are important to pay attention to because that is what the Fed look at pretty much to determine how they're going to have or maneuver monetary policy, what they're going to do. We had advanced GDP come in higher quarter over quarter. So last quarter, which is Q4, came in at 3.3, and it was forecast at 2%. And so, you know, it's a little higher, but keep in mind, um, fourth quarter of the year is typically a high volume year. And so, or year, high volume quarter. And so even though the GDP is down from the previous 4.9, it's still, you know, decent, better than expected. So that means the gross domestic product that is being produced by the US is, still growing somewhat. So that's good. Now, why would I mention that report? Well, one, because it happened this week and I'm doing this on a Friday. And as well, I need, you guys to, you know, look at these reports when you're curious. You can go to, I personally use forexfactor.com, not a sponsor. I don't know who they are. I just use them as a economic calendar. And, you can find those reports also by typing it in Google. But back to monetary policy. So we know that we talked about last time was the OMO, and pretty much what that did for uh, the economy and Fed's decision making. Today, we're going to talk about the discount rate and the reserve requirements. And so we know with the OMO, the Feds use that to purchase and sell securities, usually debt securities, to kind of help increase or decrease the money supply. Now, they also use a thing called the discount rate. So they also use like the interest rates. Why is that important? Well, that's important because when you are trying to put more money into the economy, you know, you want to increase spending. What would give someone the incentive to go out and purchase things? It could be purchase small things using the credit card. It could be purchase large things using mortgages or auto loans. What would cause someone to go out and do those things? Well, the interest rates. So if they wanted to increase spending, if they wanted to increase, people going out and being active in the economy, well, they're going to lower the interest rates. And the opposite can happen as well. If they wanted to, slow down spending, they could easily, you know, increase the interest rates. I'm pretty sure we talked about that before. But the discount rate is something that they use to discount is using discount cash flow. So pretty much it determines the future value of cash essentially. And so there are I'm not gonna lie to you, I don't know, I'm not an expert on the discount rate. I know what it does. But to do a deep dive into it is something that I'm going to recommend you guys do. Um, but just a few things I do know, it is some a you know it's something that the Fed use to when commercial banks when they want to borrow money, they're usually will have to borrow money from another bank, um, and that's one of the rates that they use. Now, if you have to borrow money from the if you have to borrow money, sorry about that. If you have to borrow money from the Feds, like if you're an institution, not you and I, but like an institution, typically you don't want to do that. If you are a bank, that's usually the last resort, 9 out of 10 times, mainly because those interest rates are determined by you know the Feds, and you pretty much will be paying sometimes a higher um what's the word I'm looking for, interest rate. So borrowing from the Fed as an institution is one of the ways. If you are a struggling bank or institution, you can do that essentially. And so that's pretty much what the discount rate is. Just the interest rates that the Fed use, and it can determine the future value of cash and things like that. But one of the things, the reason I quickly went past that, one, I'm not super knowledgeable on it. Not gonna lie to you. I'm not gonna pretend. I did my research on it, and I looked into it. I read up on it, but it's very simple. Basically, what I just said. It didn't go deeper into it, but yeah, that's pretty much what you're going to get for now. But what the one thing I do know a lot about, and I find interesting, is the reserve requirements. So the reserve requirements, the discount rate, our interest rates, and OMO pretty much make up monetary policy. Now, what are reserve requirements? And so reserve requirements is pretty much what institutions need to have in the federal bank for making sure they can cover their depositors if there ever is a bank run. So, what is a bank run? Essentially, if let's say some news came out and something is happening in the US and everyone freaks out and they all rush to the bank to go take their money out. 9 out of 10 times, banks are already lent that money out to make money. That's what banks do. And so, in order to meet that demand, if something were to happen, you need to have a reserves for that, cash reserves. And the federal government can change those requirements. They can say, hey, you need less. So if you need less, that means you can have more money to go out and give loans. Or they can say, hey, you need more, meaning you need to save some more and therefore drawing away from the cash. So you don't have a lot to make loans and give out credit and things like that. And so the reason why that's to me is interesting is because essentially the federal government can control the savings accounts of banks. Essentially, that's how I view it. And knowing when the requirements, not just the interest rates, but knowing when the requirements are going up or going down can also be a factor into understanding what the feds are thinking or what they may do in the future. Of course, you don't try to think for the feds. You just try to follow along the best you can. So when it comes down to investing, when it comes down to home buying, when it comes down to any kind of thing that is dealing with money, of course, speak to your financial provider or your financial professional. like your financial advisor, investment advisor, what have you, wealth manager. But if you don't have those things, you don't have those people, then these are some of the things you can look at when it comes down to monetary policy to help you determine to make a um, wise decision on what you should do with your finances. So, I know it's a short episode. I'm not gonna lie. I kind of threw this episode together, not because I'm just disinterested, because I've been extremely busy. A lot of positive things are happening, and it's taking a lot of my attention. And so I'm going to try to go back to recording as many of these episodes as I possibly can, and then put them out there for you guys. But if ever get in a situation to where, hey, I ran out of videos and I have to, put one out, I'm still going to do it. So hopefully I gave you guys some worthwhile information. That's the end of the monetary policy, monetary policy conversation. It's very super simple stuff. Not gonna lie to you. Stuff you can read up on in a weekend, and a lot. So understanding what monetary policy does and what these reports can do for that is important in investing. So with that being said, that is it. So I appreciate you guys staying with me on another week, and I appreciate the views, the likes, the comments, and all that stuff. And until next time, guys, well, stay well, wise.